Selling a luxury home can be one of the most profitable decisions you'll ever make. But if you're not prepared, it can also be one of the most expensive surprises that you ever get. I am, of course, talking about capital gains tax. Now, I'm not a tax advisor. I'm not a CPA. I want to be absolutely clear about that up front. I'm not here to give you tax advice. I'm a real estate marketing expert and I'm a broker owner of Maxim and Maxim Realty Orlando, and I have quite a lot of experience in the luxury home market. So what I can do is help you ask the right questions, understand the big picture, and I can also connect you with the right professionals to help you make the smartest move when the time to sell your home is right. So what we are going to do in this video, we're going to explore what every luxury homeowner needs to know about capital gains tax and what you need to consider in terms of capital gain tax when you are thinking about selling a home. I'm not going to provide you with any legal advice, simply not qualified for that. I'm not going to give you any tax advice, again, not qualified for that. I am just going to start you could call it a smart conversation, or an educational conversation about what capital gains tax is and how it can affect you when you're selling your high-end property. Before we get started, I'd like to introduce myself for those of you who have not watched any of my videos before. My name is Danholm. I'm a real estate marketing expert and a broker owner with Maxim Realty Orlando and Maxim LLC. I have helped countless luxury homeowners navigate the process of selling their homes in a way that would maximize value, minimize stress, and avoid costly mistakes. But again, and I really need to emphasize this, I am not a CPA and I'm not an attorney and I'm definitely not a licensed tax professional. So everything I'm going to share in this video is for educational purposes only. When it comes to your specific tax situation, you need to talk with a qualified tax advisor. What I do hope to do here is simply to give you the framework, so to speak, the context, and some key things that you should be thinking about as you plan your next move, if that next move involves selling your property. So even though I'm pretty confident that most of you who have been hanging on this far probably know what capital gains tax is, but if there should be one or two out there who doesn't, I'll just make sure that I cover this now. And specifically also why you as a luxury homeowner need to care about capital gains tax. Well, at its core, capital gains tax is the tax that the IRS may require you to pay on the profit you make when you sell any asset. In this case, we're talking about your home or your property. Now, not all of that gain is necessarily taxable. There are some exclusions, there are some thresholds, and there's some other rules that could impact whether you owe anything at all. But here's the thing, and this is why I'm talking about luxury homeowners all the time. Luxury homes, high-end homes, often sell for prices that far exceed the standard exclusion limits. So while somebody who's selling a $300,000 starter home, definitely most likely, I should say, I'm not a tax advisor. I also will rephrase that. Most likely will not trigger any tax at all. Somebody who's selling a $2 million home or a $5 million estate or a $10 million estate, very, very different story. And that's where planning comes in, and that's why this is so relevant if you own a high-end property. Because let's say you bought your luxury home 10 years ago for $1 million, and now you're selling it for 2.5 or 3 million. Let's stick with the 2.5 for ease of reference. That's a 1.5 million gain. Obviously, the IRS doesn't always tax that entire amount. There's something called the primary residence exclusion. If the home you're selling is your primary residence and you have lived in it for the last 2 out of the last 5 years, for at least 2 of the last 5 years, you may be eligible to exclude up to $250,000 of that gain if you're single, or up to $500,000 if you're a married couple filing jointly. But here's the catch. Anything over that amount may be subject to capital gains tax. So in this example that I just put, you bought for $1 million 10 years ago and you're selling for 2.5 now. Even if you're married and you can exclude 500,000 because you fulfill the requirements, that still leaves you with a potential taxable gain of $1 million. Obviously not a tax of $1 million, but a taxable gain of $1 million. So depending on your income and how long you own the property, might not have been the 10 years I said, that gain could be taxed as a long-term capital gains tax, and that rate currently range from anywhere from 0 to $20 federally, and potentially even higher if you're subject to the 3.8% net investment income tax. If you don't live in a non-income state tax like Florida, state taxes might also apply. So it all depends on where the property is located. Another reason maybe to move to Florida, because we do not have that thing called state income tax. Again, I'm not giving you tax advice or anything, but I was trying to give you some moving advice. I'm just telling you what's commonly known and available from public IRS resources. You need to talk to your advisor for your specific situation. Now, one thing that's really important to note is that the exclusion of the 250/500,000 only applies to your primary residence. So if the home you're selling is a second home or an investment property, what happens then? Well, that's where things get even more important. That's where it gets even more important to plan carefully. If the home is not your primary residence, let's say it's a vacation home you visit once a year, or maybe a rental property you've been leasing out, it likely will not qualify for the primary residence exclusions. And that means that your entire gain could be taxable. In some cases, especially with investment properties, depreciation recapture can also come into play. And that's another area where you definitely will want to talk to your accountant or maybe a tax professional of some sort to walk you through those numbers. So that's lots of nuances. So it's, like I said in the beginning, this is all about your specific situation. But let's, in general terms, talk about what actually goes into calculating your capital gains tax, or your capital gain that is taxable. It's not simply a matter of subtracting your original purchase price from your sale price. You would also have to account for your cost basis, which is the amount you originally paid for the property plus certain allowable costs. These allowable costs can be settlement fees, closing costs, maybe capital improvements, and they are probably in this case the most important ones, because capital improvements are renovations or additions that you made that increase the value of your home or extend its useful life, or maybe adapt it to some new uses. So if you put a new roof in, maybe you did a high-end kitchen remodel, or maybe added a guest house or a new luxury pool, these could all increase your cost basis. The higher your basis, the smaller your gain. But again, one thing that's really important here, documentation is critical. It's not enough to tell Uncle Sam that you actually did these things. You need to prove these expenses with receipts, with permits, or with contractor agreements. Again, this is where your CPA, your tax advisor, becomes really handy, and they can really help you determine what qualifies and what doesn't, because some improvements that you think is an improvement might just be considered maintenance. So again, keep all receipts and then discuss with your CPA or your tax advisor. Something that also sometimes gets a little bit overlooked is timing. Again, and I'm treading a little bit carefully here, I'm not trying to give you tax advice, but timing can actually affect whether or not you qualify for the exclusion, can also affect how much gain you realize, and it can even determine what tax rate you fall into. Let's say that you own the property for more than 1 year. Your gain might be taxed at the long-term capital gains rate, which is generally lower than the short-term rates. So if you're sort of just on that cusp of 11 months to a year, where for the closing date, maybe talk to your accountant and see if it's worth pushing that closing date just another month to see if that lowers your tax liability a little bit. Because if you sell before that 1 year mark, the gain you make could actually be taxed at your ordinary income tax rate, which is likely to be significantly higher, especially if you're in a top bracket. And most people who own property in this price range are in a top bracket, so you get hit twice. Also remember that you have to have lived in the home for 2 out of the last 5 years to claim that exclusion that we were talking about earlier. It does not have to be 2 years in a row, but it does need to add up to 24 months. So if you recently moved out, or you rented the home, or split your time between multiple properties, it's really essential to work with a tax expert to make sure that you still meet the eligibility requirements, and that you keep some kind of record that proves that if you're sort of on the cusp of making the 2 year or not, have records that show where you were, if possible. Some people also ask me, what if I'm selling because of a change in circumstances? And again, if they ask me that specific question, I refer them to a tax professional. However, in general terms, maybe if you have a job relocation, if you're selling for health reasons or other major life events, that might affect it, because the IRS does allow for some partial exclusions in some cases. So that's another reason why it's really, really important that you talk to somebody to make sure that you do it right and get all the exclusions that you can. Because these circumstances means that you might still be able to exclude at least a portion of your gain, even if you don't meet the full 2 out of 5 year rule. And this is truly where your CPA can earn their keep, by the way, because the rules are really nuanced and you don't want to make any assumptions here without professional guidance. Another question that comes up sometimes is whether a 1031 exchange apply when you're selling a luxury home. And that depends, because what a 1031 exchange is, it allows you to defer capital gains tax. It does not eliminate it, it defers it. When you sell one investment property and reinvest the proceeds from that investment property into a like-kind property. There's some deadlines, and they're really important that you need to meet. Some other rules you need to meet. But this is a really powerful tool for investors. But here's the thing that's important if you're selling your home. 1031 exchanges generally apply to investment or business use properties, not personal residences. So if you're selling your primary residence or maybe your second home that you didn't rent out as a business, you're likely not going to be able to use 1031 exchange. However, on the other hand, if your property has been used as an investment, like a rental property, you might have options to defer your taxes under Section 1031. Again, really depending on specific criteria and timelines. This is absolutely something you need to run by your advisor early in the process to make sure you get this right, because the rules are pretty strict. So you need to make sure that you do it right to get the full advantage. And now that you talk about early, so when should you start thinking about capital gain tax if you're selling your house? And the answer is, at least in my opinion, before you even list your home. Ideally, you'll be talking to your tax professional before you even put the property on the market. And why is that? Well, it's because planning ahead gives you the opportunity to gather all your documentation, strategize the timing, and generally look at the full tax picture. For example, it's another thing we didn't discuss earlier. If you're selling at the end of the year and your income is unusually high that year, it might make sense to explore pushing the closing into the next tax year, depending on the specifics of your situation. But if you're expecting to have a lower income the next year, it would be definitely worth talking to your CPA or your tax advisor to see if you can save some money if you're pushing the closing to the next year. So if you wait to do all these things till after the closing, your options are a lot more limited. So in this case, proactive planning beats reactive cleanup every single time. And even though I'm located in Florida, where we don't have state income tax, let's not totally forget about state and local tax implications. We don't have state income tax. So I think I mentioned that before, might be a good reason to move down here. But if you do insist on living in an income tax state, you should know that your capital gains could generally be subject not only to federal taxes, but in some states, you might be dealing with additional layers of taxation. In states like California, New York, New Jersey, and other high tax states, that can impose significant capital gains taxes on top of the federal burden that you're already bearing. which is another reason to work with a tax advisor who understands not just the federal picture, but also the state level implications based on where you're located. And if I may push that in here again, another reason to consider moving to a non-state income tax state. Now, some people ask if I'm pretty sure, I think I don't owe any capital gains tax. Do I still have to report the sale of my home? And again, not being a CPA or a tax advisor, I would venture to say the answer is probably yes, at least in most cases. Even if your entire gain is excluded under the primary resident rule, the IRS may still require you to report the sale. Especially, especially if you receive a 1099-S form from the title company or the closing agent, because typically sales are reported on IRS Form 8949 and Schedule D on your tax return, and so there's a space for it on your tax return, so likely you'll have to report it. But again, that's between the three of you, your CPA, the IRS, and yourself, but you should definitely check with your CPA. Just know one thing, that selling a home, particularly one with a high price tag, is very likely to trigger some form of reporting, even if it doesn't trigger a tax. So let's talk for a moment about, let's talk a little bit about strategy, not tax strategy. I will leave that to your professionals, but real estate strategy. As a seller of a luxury property, your timeline, your pricing and marketing all play into what financial outcome you get. Taxes, of course, are part of that equation too. But I always recommend my clients to look at the full picture, not just what they think they'll sell the house for, but what they expect to net after all costs are considered, including potential taxes. And what I do is I work with sellers to ensure that they have a clear idea what improvements they made, what record they have, what they can do to position the home to sell within a time frame that works for both financial and personal goals. And when needed, I am more than happy to bring in a trusted tax professional. If you don't have your own, I would say that most of my clients do have their own tax professional, but should you not have one, we can definitely put you in touch with one so we can create a strategy that aligns with your bigger picture, because this is what it really is all about, is your bigger picture. So let me ask you this. Have you actually thought about how much of the profit you get for your home that you might actually keep after taxes? Have you ever looked at your original cost basis and considered what improvements you made, or even checked if you have any eligibility for exclusions? Or do you already have a plan in place with your financial team to navigate this when the time comes? I'd actually love to hear your thoughts. So if you could drop a comment below and let me know. I read every single comment on my videos. And if you're in the early stages of thinking about selling your luxury home, I'll be happy to talk. And I've said that a few times, I cannot give you tax advice. I can absolutely connect you with a trusted professional who specializes in real estate tax matters. And I can help you get your home sold. So I hope you enjoyed the video. I really do. And if you did, why not tune in next time when I upload a video. I hope to see you in my next video. Thank you so much for watching. Bye for now.